and welcome everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It is Monday, February 1st, 2021, and I'm pre-recording this Trading Places Live for Tuesday, February 2nd. Futures are a little mixed, slightly down on both the Dow and the S&P 500, and slightly higher on the NASDAQ after a very strong day. We'll see what happens to those futures overnight, but typically, the start to February is fairly bullish, and typically the start of just about every calendar month is bullish. That's when we see new money coming into the market, so we generally see the market move higher the last couple of days of one calendar month through the first handful of days the next. February is a little bit different in that it only shows strength for the first few days, but that would take us through Wednesday. We'll see what happens, but at least history is on the side of the bulls, and it helped on Monday. Let's go ahead and jump over to earnings beats here. I do want to first share the agenda with you, though. Let's go. Well, I'll get into the daily market recap in just a minute. Talking technically, I want to go through some of the sectors. I take a top-down approach, and I think I've got some pretty enlightening sector information based on relative strength that I think you might enjoy. Maybe you might even be a little bit surprised. Then I'm going to get into mailbag. So this will be a new feature. I actually think I may have done the mailbag a couple weeks ago, but I get a lot of questions at Earnings Beats, and I wanted to focus on a question dealing with our service at Earnings Beats. Then we'll get into Earnings Spotlight. So there we got earnings season picking up, some companies reporting after the bell. I think you'll be very interested to see some of those companies and their relative strength and how they're performing and how they reported, and the after hours action as well. So we'll get into that, and then we'll wrap up with the three you must see. These three were specific requests by Earnings Beats members, and I want to go through and take a look at those charts. I'll show you what I think of them currently. First, though, let me just introduce those of you that are new to Earnings Beats. I want to introduce you to a couple things that we do. At our homepage, you'll see that we have a free Earnings Beats Digest newsletter. We publish this Monday, Wednesday, and Friday morning. It's usually just a couple paragraphs with a chart. Very simple, very quick, but it's educational in nature. Also could be trading opportunity. But normally we feature companies based on upcoming earnings, or maybe they've already reported, or it could be based on relative strength, something along those lines, things that we place so much emphasis on at Earnings Beats. All you have to do is type in your name and email address, hit that subscribe button. No credit card required, and you can unsubscribe at any time. So love to have you join our community. We have thousands and thousands of folks on this newsletter, and love to add you to the list as well. If you'd like to try our service, you can get into our service for a no-cost 30-day trial. So it's $7 up front, but then that $7 is refunded to you. One of the keys that we do, we try to show folks how you can use our teaching. And if you look at our portfolios, the performance has been outstanding. And it's something that I think that is easily adaptable. We look for leading stocks and leading industry groups, and you certainly can see the performance there. I think it's a strategy that works, continually putting money to work in areas of the market that are working for you. But anyway, I'd love to have you check that out. As far as the action on Monday, I think there were a lot of folks a little nervous coming into this week after last week's selling. I didn't really know what to expect. To be honest, I'm very bullish going forward. So I was looking at last week's selling as an opportunity, but still, when the volatility picks up, you really don't know exactly where the bottom is going to go in. I just felt like it wasn't going to be a big selling episode, a huge selling episode. Anyhow, we did get some really positive action. Saw the Dow Jones Industrial Average up 229 points, the S&P 500 up 60, the NASDAQ up 332, mid caps 48, and small caps 21. If you look at the percentages, saw a little bit of strength in the NASDAQ, a little bit more strength in the NASDAQ and the mid cap stocks, and maybe even a little bit in the small cap versus the S&P 500. So it was a pretty good day all around. I would say that the Dow Even though it was up 229 points, finished at 30,211. It did finish below its 50-day. It still hasn't gotten back through the 50-day. And when I see a top like this, and then I see failure at the 20-day moving average, I start to think consolidation, because in a trending environment, normally you hold the 20-day. So in this case, you can see the major indices, we did fall below it, kind of moved back up. NASDAQ's well above its 20-day again, but it could simply just be some consolidation. We may see some of this back and forth action for a bit. Amazon, Google both report their earnings on Tuesday after the bell. I think that's going to be really critical to whether or not this market breaks out. If they both report strong numbers and we still can't get going, I think it's starting to point more and more toward a period of consolidation, which isn't a bad thing. I mean, we want to go up every day, but the problem with going up every day is that you get stretched. And then when you do see selling, you see a lot of selling back to the downside. So I would rather see some consolidation, a little basing, and then the next breakout could be much more meaningful. That's the way I'm looking at it. As far as sectors go, I was very pleased to see that with the strength, consumer discretionary and technology were the two big leaders. I mean, these are, I would say, the two most important sectors in a secular bull market. These are the two that are really going to perform well. And so when the market gets this first bounce back, to see money rotating right back into these two areas, I find very encouraging. Also, if you notice, the worst performing group on Monday was consumer staples. So consumer discretionary was the best. Staples was the worst. Aggressive does well, defensive does not. That's usually a good sign too when the market moves up. The two best performing industry groups, we had marine transportation and autos. Marine transportation up 6.72%. This was actually one of the groups I mentioned in our seasonality report that went out to members over the weekend. February seasonality, marine transportation does like the February period. And I'm going to try to remember in just a couple minutes to take a look at that for you. I'm just making a note because I think that's kind of a interesting area here over the next few months. Autos also bouncing very nicely, easily back above the 20-day and 50-day moving average. Well, 50-day it's been above for quite a while. The 20-day moving average, though, was at 994. We had actually closed just below that on Friday, but came right back up above it, which is a good sign for the autos. So all in all, I thought really good action on Monday, especially given what we could have seen today after the selling at the end of last week. All right, 10-year Treasury yield. I do want to mention on Tuesday, not really anything in terms of significant economic reports. So the bond market will be left to trade basically on its own. I do like the fact that we've bounced off that 1% gap support area. I think we're in a range now. Talked about this a little bit on the Trading Places Live at Earnings Beats on Monday morning. And I just think we're probably range bound between, say, 1% and maybe about 117, 118. You do have gap support down around 0.95, this double top around 0.97. So it wouldn't be horrible. And the 50-day, by the way, sitting at 0.97. So it wouldn't be horrible if we lost 1%, but that is a psychological level. So it'd be nice to continue to hold on to that. The significance here is if we can continue to hold on to support, it will just reduce the amount of money that leaves the stock market for some area that's more defensive like treasuries. So anytime the yield is going down, that means the price of treasuries is going up. So this kind of a move, which is to be expected, resulted in money moving back into treasuries. But over the course of the last few days, you can see that money coming back out of treasuries, sending the yield higher. I don't think it's really a big deal as long as we stay above, say, 0.95. Below that, that would be something to reevaluate, especially if it was coinciding with other warning signs. That by itself wouldn't really bother me, but if there were other things starting to crop up, then that would be a reason to take a pause on the market, stock market. All right, let's move on. Talking technically, I wanted to show you this sector summary. So there's your consumer discretionary and technology. Real estate had a pretty good day, and then communication services, financials for the top 5 groups. If we strip out that real estate group, 4 of the top 5 were aggressive groups today on this bounce. So that's pretty encouraging. What we wouldn't want to see is to see a bounce and then have defensive groups leading it to the upside. That would paint a picture that we're probably not done going down. This tells me maybe we're done. Maybe. We haven't broken out. We've got a lot more work to do, but at least it was still very positive rebound and positive action after what we saw at the end of last week. All right. I also want to go through and show you relative strength. You may not realize this, especially, nobody talks about this stuff on CNBC. Technology on a relative basis today broke to an all-time high relative to the S&P 500. I didn't even know it until I looked at my relative strength. I saw technology was doing well, and I thought, okay, well, let's see how it's doing on its relative strength chart. And there it is. It has broken above that, or to that 0.0350 level, which clears the level that we saw all the way back in August. That's a really good sign. When you've got technology breaking out, especially after a 4 or 5 month consolidation, that I believe is a very, very good sign for the market. We'll see whether or not we get some follow through, but that beats the alternative of seeing this group underperforming. All right, as we go through these others, consumer discretionary. Consumer discretionary, you may not have known it, but just within the last couple of weeks, we had an all-time high here relative to the S&P 500. So the two groups that I believe are the most important groups in the market are both breaking out here in the last couple of weeks. We've seen breakouts in both on a relative basis to the S&P 500. I think that's very important. Communication services, well, we bounced back. We held that triple bottom relative support area. We've bounced back, haven't broken out yet, but still, again, just like technology, it beats the alternative. This coming back up to the upside is good news. Industrials, this is the one that really is confounding me. I'm really surprised. I would have thought that 20-week EMA would have held. That I really thought industrials were making this move back. We're still above the zero line, so I'm still holding out hope that we get a move back, but I did not want to see industrials go back below the 50-week moving average on a relative basis, and they have. Now, if you look at the absolute chart, we still got an uptrend in play. So don't confuse the two. We've been moving up from this low in October. We've gone higher. It's just that on a relative basis, we haven't gone up as much as the S&P 500. So we're starting to roll over. And industrials are one of the aggressive areas. So we really would like to see this group do better. Financials had been very strong into the end of the year, into early 2021. Ever since the banks started coming out with their earnings reports, though, we've seen profit taking. Buy on rumor, sell on news. I'd like to see this one hold and start to turn back to the upside. That would be good news for the market. Healthcare continues to drift lower on a relative basis. So overall, I think we have to be a little careful with the group. And once again, when you look at the absolute chart, healthcare is going higher. I'm not saying it's going down. It's going down on a relative basis. So when it's going up, it's not going up as fast as the S&P. That's why the relative number is going down. You can see that relative PPOs in negative territory. Not a big fan because that's telling us that the relative momentum it remains weak. It's not been strong enough to get us back through that zero line. Consumer staples couldn't be much worse. I mean, look at this. We're talking about a 2-year relative chart, and we're right at the bottom. While we're setting not only 2-year highs, but all-time relative highs on consumer discretionary. The other side of consumer stocks, the staples area, setting 2-year relative lows. Not what we want to see there. So consumer stocks I like, but I like discretionary, not the staples. Real estate's bounced back, but it's bounced back for the last few weeks. It was coming off a huge low, like staples, multi-year relative low. We're moving higher on an absolute basis, but not very fast. And the S&P's had a huge run. So we're just losing in terms of relative strength. I'm not interested in getting these relative or these dead cat relative bounces. I mean, we saw this back in May, June. That, if you jumped into real estate after you saw a little bit of relative strength, you would not have been happy. Same thing here. We got a lot of work to do to get back through that zero line. Next up, utilities. Same thing, heading lower. This is another defensive group, just like real estate, just like consumer staples. Defensive groups are not performing well. That should tell you something about the strength of this market. If If Wall Street believed we were going lower, trust me, defensive groups would not be trading at multi-year lows on a relative basis. Wall Street would be moving money into the groups, not taking money out of the groups. Ignore what you're hearing on CNBC. Try to avoid the negative and all the negative action, all the pessimism. Just my opinion, but I'm showing you why I feel the way I do. Energy has rolled over a couple of months, pretty strong, but it's struggling here. Look at it struggling at its relative zero line. Hasn't been above it in a couple years, and it's struggling right there. You can kind of see which way are we going to break here. I'd be a little careful. On an absolute basis, we still haven't even gotten above the June high. Yes, it was strong. We had a really good couple of months in energy. But I said at the time, I wouldn't trust it, and I'm sticking to that. I also said materials have been doing really well, but I'm still nervous about materials. And now we're starting to see materials underperform. You might say, well, why? Why? What's the matter with materials? What's the matter with energy? Why wouldn't they do well? They've been, off, especially energy has been off for many, many years. Why isn't now the time? Well, it comes down to relative strength. I think they're going to go higher. I just don't know that they're going to lead. And what it really comes down to for me is checking out what I think the dollar is going to do. So if you follow this chart, and I've gone through it many times, I don't want to spend a lot of time on it here, but the difference in yields between US and Germany, you can see the chart up here, the difference, not the relative strength, just the difference, just taking one, subtracting the other, and then plotting it. You can see kind of going up, US dollar goes up, and it all makes sense. This makes common sense because when the economy strengthens, you sell bonds and yields go up. So if our yields are going up faster than Germany's, it's telling us, the market's telling us that US economy is stronger than Germany. And if that's the case, the dollar should go up. And what we see is a very strong positive correlation for the most part between this difference in the yields and the direction of the dollar. But occasionally, these shaded areas highlight these inverse correlations when we actually see quite a bit of inverse correlation or negative correlation, meaning that the dollar is going opposite the direction of the difference in yields. And in every case over the past 15 years where we have seen this inverse correlation, the dollar has been the one that reacts. So here, the yields were going up, dollar was going down, the dollar reacts up. Here, yields going up, dollar going down, dollar reacts up. Here, yields going up, dollar going down, dollar reacts up. Here, yields going down, dollar going up, dollar reacts to the downside, comes down. Now look at this latest green shaded area. Yields in the US are going up versus Germany. The dollar kept going lower. I believe the dollar goes higher. And if the dollar starts to move back up, I don't know if it's going to go up right away. We're starting to see a little strength here, but we could go down to 89 on the US dollar index. We're 91 right now. So we could still maybe go down and test this support area. I'm not ruling that out, but I do think the longer term picture, we're looking at another 3, 6, 9 months. I believe the dollar is going to rebound. And if the dollar rebounds, that's going to put pressure on both energy and materials on a relative basis. This whole move up on the dollar since 2011, energy and materials have been underperforming the S&P 500 since 2011. It's the dollar. And so if we're getting signs that the dollar is going to strengthen, I think you got to be careful with energy and materials. All right. I did want to mention one other thing. So let's, I'm going to pull up the seasonality chart. I said I'd show you the seasonality on the marine transportation. So here is the 5-year. Let me pull it back. So 20 years, over the last 20 years, look at the percentage of times that the marine transportation moves higher. And we probably, let me put the S&P 500 in here. Well, over the last 20 years, it's about 50-50 in February. But what you can see is that the average outperformance in February is 1.2%. So over the last 20 years, marine transportation stocks have averaged gaining 1.2 percentage points more than the S&P 500. And if we just get rid of that and just look at the absolute, and stretch this back to 20 years. I mean, you can see the percentage of months that marine transportation actually goes higher during that month. 65% of February's, 68% of March's, and 74% of April's. So clearly, these next few months, we do tend to see strength. And if you look at the actual returns, add those three together, we average going up about 6.4% over the next 3 months in this area. And if you look at the rest of the year, we don't really do too much. I mean, I'm not a fan of marine transportation because just historically, they haven't produced much. Now, during this bull market, if we go back the last, basically, let's just say the last 10 years, check out the February, March, April period. I think I mean, it literally is just kind of standing out like a sore thumb there. So it's something to at least consider. But this is a group that long-term, the chart doesn't look all that great to me. But seasonality at least points us in this direction. All right, mailbag. I wanted to, I've been getting so many emails at Earnings Beat, so I think I'm going to have to get into a mailbag section or segment where I can talk a little bit about some of the questions that come through to me. And this one's kind of near and dear to our heart at Earnings Beats because it's talking about our flagship strong earnings chart list. So what we do, and I'm going to pull this up in summary form here. What we do at Earnings Beats is, or one of the things, we do a lot of things, but one of the things we do in our research platform is, you know, my background is in public accounting. I was in public accounting for 20 years, and I believe it's really important that management teams under promise and over deliver. And so what I mean by that is that they provide estimates for Wall Street. I think it's very important that companies come in and beat those estimates, both revenue and earnings per share. And so what we do is look at all the earnings reports that come out, and companies that beat both revenue and earnings per share, beat Wall Street estimates, are liquid, meaning that they trade at least a couple 100,000 shares a day on average, and look good technically. Now, look good technically is kind of loosely phrased. I mean, I'm going to look at it. It might be that the company itself looks awesome, and you know, there's no reason why you wouldn't want to have it on the list. But it could be that it's a company that just reported some strong earnings, and maybe it's in a strong area. So, for instance, if a company's in semiconductors and reports strong earnings, I would probably reward that company more and consider putting it on this chart list rather than, say, a company in airlines that has a, you know, if an airline has a poor looking chart and they come up with better than expected earnings and the company isn't, you know, and Wall Street's not impressed, we don't get a big reaction to it, I'll ignore it. It won't go on here. Even though they beat earnings, it will not get on our list because technically the market, for whatever reason, doesn't care. We want the market to care. We want to know that we're trading a stock that is performing well and that is at least part of a strong group. And so, I mean, if it's in a weak group, but it's off the chart strong, that's okay. We're still fine with that. But in the end, what we really want is a strong company in a strong group. That's really where the portfolio stocks come from, you know, that I talked about at the very beginning. That's how, I mean, when we look at the performance here at our homepage, and we update this every day, by the way, so you can come in and check it out anytime. But when you look at all these numbers and how we've outperformed the S&P 500, it starts with this strong earnings chart list. Now, the question, I'm going to sort this in order. The question that came in, and I get this sometimes, this chart list has a varying number of companies on it throughout earnings season. And so the specific question that came in is right now, if I put this in edit form, you'll see, right now we have 232 companies on this list. So the question was, we have, you know, there's 232 companies now, but recently it was over 300. And so, and I've had a couple different questions. I'm going to kind of paraphrase them to kind of put them together. But essentially the question is, how do we put these together? And if I, you know, if this latest strong earnings chart list is updated, it overwrites the last strong earnings chart list that we provide our members. And so what happens to those other companies when we were over 300? They disappear if we overwrite. Well, the thing you have to understand about these is that this is a revolving door, if you will. As companies are about to report, they get removed. So as ACM and Baidu and all these other companies approach their earnings dates, we remove them from the report. So they're not on here when they report. Now, if they come through and they produce great numbers and they beat Wall Street estimates, they get added right back onto the bottom. So it's just this constant flipping that takes place. So when you look at the companies on this list, you know that you've got companies that we've already vetted. We've checked them out. We like their earnings. Wall Street likes their earnings. The companies are, doing fairly well, or their industry group is doing well. And so any company you look at any point, you know that you've got strong results. So anyhow, that's how the list goes down. So as you're going through the middle of earnings season, when all these companies are coming out, they get removed from this list. That's why the list drops. And then after they report, we go through this deluge of companies that report. You'll see this back up over 400, maybe even close to the 500 limit. We were close to 500 recently. So that's the way it works, and that's the way it evolves. All right, earnings spotlight. Just wanted to go over a couple of these stocks. One that I wanted to mention is Vertex Pharmaceuticals. This is a biotech that just missed their earnings estimate this evening, Monday, $2.51 versus $2.65. Look at the chart. Biotechs are moving up. Vertex has been moving down. Look at the relative strength. Vertex is at a 52-week relative low, not just to the biotechs, but to the S&P 500. Wall Street doesn't like it. They go out and meet with management. They don't like it. Well, guess what? The company just missed earnings. I mean, you can call it luck if you want, but I think Wall Street sends us messages, and that's a perfect example. One that was interesting, though, they did beat by a wide margin, is NXP Semiconductor, 268 versus 211. Stock's been in a nice uptrend. Don't like the AD line, by the way. That would be one negative. And its relative strength has been going up versus both the semiconductors and S&P 500. But, I wouldn't say it's the strongest semiconductor. So I don't know how they're going to react tomorrow. Right now, after hours, Wall Street not very impressed. The stock down 3% after hours, but still, it's in its uptrend. We'll see how it reacts after the open. But if I was looking at, say, a semiconductor, look at Micron. Look at how Micron is performing relative to semis. Look at Applied Materials. It's pulled back a little bit recently on a relative basis. But look at that move. You want to see a small company absolutely blowing things away here? Look at Atomera, ATOM. Look at the relative strength just shooting up versus semiconductors. These are areas where Wall Street does like. So something like that is what you want to pay attention to. All right, 3 you must see. Got about 30, 40 seconds here, so I'm going to go through pretty quick. But these were all questions from members. IRTC came out with some Medicare reimbursement issues for the stock, and you can see huge move down. Question is, what do you do with something like this? Well, normally you get an overreaction. We went down, tested gap support, starting to bounce. We're in a very wide range. It's going to be volatile. I don't really know what to tell you. I do like the long-term chart on the stock, though. Next up is FedEx, wondering about a positive divergence. Well, I don't have the line or the PPO showing here, but yes, PPO actually does show a higher low, whereas you've got lower low in price. So you do have a positive divergence there. Last one I will go over is Chewy. And Chewy, question is, concerned with a trip below the 20-day. All I can tell you is you've got a very volatile stock. I would be looking at the trading range right now between about 88 to 90 on the downside and about 112, 113 on the upside. We're right in the middle of it here. All right, that's it. Appreciate everybody tuning in. I'll be back on Wednesday morning over at Earnings Beats for your next Trading Places Live. Happy trading, everyone.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.